broadcast.
Okay, so we can start, no? Okay, good morning, everyone. Good afternoon and good evening, and welcome to this first virtual discussions on the global economy transform. Let me first thank all of you around the world who have accepted to join this conversation and that you are all well, despite these unprecedented times that we are all facing. We might all be physically confined by space, but our mental space is wide open and has no restriction. So this is in this context that we can engage all of us to understand what might be the future of the world economy. COVID-19 is foremost a human tragedy. It casts a dark shadow over the world economy, with global growth now projected to contract by close to 3%. We are in a new equilibrium of global economic inactivity without precedent in economic history. Let me try first to introduce our speakers and to tell you exactly how we are going to divide the scenario. And after we'll over to REHN and Ousmane to give also their opening remarks. I'm glad to welcome President James Bullard, the President of the Federal Reserve Bank of St. Louis. Thank you very much again for accepting our invitations. It would be nice to see you again face to face. Governor Olli, the Governor of the Bank of Finland from Helsinki and the member of the Governing Council of the European Central Bank. Governor, welcome. Benoit will be joining us shortly. He's the head of the innovation at the Bank for International Settlements. He will be joining us from Basel. And Professor Barry EICHENGREEN, Professor of Economics at the University of California at Berkeley. We will divide the program in two parts. President Bullard and Governor REHN will be speaking each for 10 minutes, and we will open for questions and answers. Please use the Zoom and send your questions, and we'll try our best to bring it to our speakers. The second part of the program will be devoted on ways the global monetary architecture might dramatically change. We are already seeing some accelerations of monetary innovation in the field of payment and money. With this crisis, accelerate call for central banks to speed up their task to issue central bank digital currencies. And this part will be moderated by Ousmane Mendeng, advisor at Accenture. Let me thank also the Chamber of Digital Commerce and REHN and Olli's team to agree to host this event with us, and also Accenture for making this event possible, but also our series reality. We'll provide soon, of course, a date for our next program. Last but not least, this is an open event. The media has been invited, so welcome to all of you. And before I give the floor to our speakers, let me hand over to REHN for a few words. Thank you very much.
Thank you, Mark, and welcome to the World Economy Transform. Just to give everyone a little bit of background on this event, we were originally planning to hold this in person in Washington, D.C. around the annual meetings of the World Bank. Of course, the world has changed dramatically over the past couple of months, so we're pleased to have everyone join us for this conversation virtually. I'm Perry Boring, the founder and president of the Chamber of Digital Commerce, and this event is being co-hosted by the Chamber, the Reinventing Bretton Woods Committee, and Accenture. I want to thank all of our partners for being a part of bringing this organization in this conversation today together. Today we're excited to jump into some very important topics around how the financial and the monetary system has been impacted by COVID-19, as well as how financial innovation has taken a forefront in international conversations in response to this. We have quite a few people that we've invited to join this event today, including members and guests of the Chamber, as well as members of the media. So this conversation is on the record, but it is a private event. For our attendees who are joining us on the webinar, there is a Q&A button at the bottom of your screen, and you can submit questions through the Q&A, and we will facilitate discussion in a question and answer session after both of the panels. Again, thank you for joining us. Next, I would like to introduce Ousmane from Accenture.
Hello, thank you very much. Hello, I'm Ousmane Mendeng, Senior Advisor at Blockchain and Multi-Party Systems at Accenture, and co-leading its central bank digital currency campaign globally. These are difficult times, and Accenture is aiming to help clients focus on the safety of their people, the mission critical services, and assessing this fast evolving environment. We are therefore delighted to sponsor this webinar series to advance an informed debate on where we are and where we may go, merging economics and fintech. The crisis has revealed persistent shortcomings and deficiencies in payment and the effective distribution of market liquidity. Accenture sees in new financial technologies opportunities to address those, in particular through central bank digital currencies and their impact on reordering and recalibrating monetary and financial relations, both domestically and internationally. Thank you.
Hey, Mark, your microphone is on mute. Hey, Mark, you need to open your microphone.
Done?
There you go.
President Bullard, thank you very much for joining us. Also, before I give you the floor, I would like to say also thanks to all the participants. We have a lot of central bank governors, academic, private sector who have been coming to our meeting for many years, who are joining us today. So, President Bullard, thank you, and we'll give you the floor.
Thank you, Mark, and thanks to everyone for organizing this event. I'm looking forward to the discussion today, and I think we'll have a good round of questions and answers. I thought what I'd do is just start out by talking and hitting on a few of the themes that I've been talking about in trying to deal with this crisis. I'll first talk about where I see the U.S. economy. I'll talk a little bit about Fed programs that have been implemented and are being implemented, and then I'll turn to how I think we can end the crisis. As far as the impact on the U.S. economy, I think the main impact will come in the second quarter, the current quarter. We're only at April 17th here, so we're only a few days into the second quarter, but I think that the numbers coming out of the second quarter will be not comparable to anything we've seen in U.S. macroeconomic history. And I think we need to, as macroeconomists, we need to get our heads around that fact. I've actually argued that we should just sort of write off the second quarter, think of it as a very different episode, and quit calculating annual growth rates and quit comparing to other periods in the past because it's deceptive in thinking about how the economy might be able to behave going forward. So just to give you an idea about what I'm talking about, in a typical quarter, the US economy in very, very round numbers would produce about $5 trillion worth of goods and services. So health authorities have asked us to have people stay at home in order to invest in health, and only essential services are being produced, and only what can be produced from work at home. Our estimates of work at home are actually quite low for the US economy, plus essential services probably adds up to less than half of GDP. So if we actually executed the health orders appropriately, you'd probably produce less than half of a normal quarter's GDP. So you'd be down $2.5 trillion in household income, in output, and therefore in household income in this quarter. So that would be unprecedented, but it's what you're trying to do to deal with the pandemic, and it's not really the same as a big demand shock or other disturbance to the economy. So I think the step one is to start thinking about this differently, quit extrapolating from past data about how you think the future is going to unfold for the US or the global economy, and start thinking differently about what's going to happen. So I think we have an email string around here that's called Still Adjusting Downward. So we've been kind of taking this viewpoint and watching Wall Street adjust their GDP forecast down, 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 down. And that's, in my mind, that's because they haven't really come to full grips with the nature of this shock. On unemployment, there are about 50 million households that are at risk. They're contact-facing jobs. If all of them applied for unemployment, the unemployment rate, could go all the way to 42%. We're saying anywhere between 10 and 42%. Estimates out of Arizona State University just recently, in recent days, say that the current unemployment rate in the US is 20.2% if we measured it in real time. So this shows you the kinds of, that's double what it was during the global financial crisis in the US. So this shows you that these numbers are not comparable to what we looked at in the past. What we're doing is using the unemployment insurance program to provide pandemic relief. And it's totally appropriate in this circumstance. You ask these people to stay at home to protect the national health, and you put them out of work, so you should compensate them for this period of time. So I want to call the second quarter of 2020 a pandemic adjustment period, kind of right off the quarter. We shouldn't expect a lot in terms of macroeconomic numbers out of this quarter. Now, what the Fed has done to react to the situation has been twofold. One is to provide liquidity programs to make sure that markets don't freeze up, including the US Treasury market, which was having liquidity problems. The most liquid market in the entire world was having liquidity problems a few weeks ago. Our liquidity measures seem to indicate that we've made substantial progress, not just in the Treasury market, but in many financial markets. So I think, at least for the first wave, we've gotten through the liquidity problems associated with this crisis, and the Fed is certainly willing to do much more on this dimension. We're also working with the US Treasury to implement the CARES Act in the parts of the CARES Act that are joint programs. And I think so far those are going well. Not all of those are even up and running at the point, but we're getting close to being able to get everything up and running. A lot of the CARES Act, which is the federal program in the US, was designed to keep households whole and keep businesses whole as they're trying to adjust through the second quarter here, where the primary disruptions will be. And I think one principle of that act has been to use the existing programs that are in place to not try to reinvent the wheel at a moment where you're trying to get cash out into the economy very quickly. And for that reason, I think the unemployment insurance program is ideally suited to get money to disrupted households. We've also got a program to distribute cash more widely. That's also being implemented as we speak. Checks are arriving in people's bank accounts right now. And we've helped a lot with that at the St. Louis Fed. We've also got the small business loan program, which isn't really a loan program, it's mostly a grant program. That program has been very successful, had a lot of take up. Congress is considering putting more money into that program. That is designed to try to keep workers better attached to their jobs as they're waiting out the pandemic here. Now, let me talk about the way forward and the way to end this crisis. I think we all understand that we can end the crisis with a vaccine, and that might be a ways away, or maybe not, depending on how you read the current news. That therapeutic would also do the trick, but everyone says that testing, both health experts and economists, including Paul Roman, say that testing is really the key here. And so I'm going to pitch an idea, since we've got a lot of economists here, about how we can ramp up the testing. So testing so far in the crisis has been considered something that hospitals do when they have a lot of people coming to their hospital that are sick. They want to figure out who's got COVID-19. But what economists have in mind is that pretty much everybody gets tested, and pretty much all the time. So it becomes pretty ubiquitous all across the nation and all across the world that, that you would be able to, if you wanted to, you'd be able to get tested for all kinds of purposes, including going back to work. Most of us are contemplating, people like me are contemplating, how are we going to reopen our institutions? Well, our people aren't going to come back to the institutions unless they're sure that the institution is safe. And to show them that it's safe, we have to have some way of saying that there isn't a virus around. So testing is really the way to go here. Now, there are big players in this market already, but as economists, we know that what they will do is they will produce tests right up to the point where marginal revenue equals marginal cost. So I think what we should do is use some of the dollars that we're throwing at this crisis to actually pay all costs of production of tests for any entity that wants to produce tests, all reasonable customary costs to produce these tests, and then let them sell the test on an open competitive market. So what that will do is create a pop-up industry globally. Well, I guess it'd be national by country, but you could create this pop-up industry in which you're essentially giving firms a chance to make unlimited profit or quite a bit of profit, because their costs are going to be covered. So their marginal cost is going to be zero of producing another test, and they can sell it on a competitive market for whatever they can sell it for. They're going to produce right up until the point where the last test produces zero revenue. So you drive the cost of these tests down to zero, and you'd be swimming in tests. There would be a glut of tests if you did it that way. Normally, we wouldn't do that kind of thing. We would say that's not an efficient outcome, but in the period of the pandemic, that's a great outcome. You basically walk outside your house and you trip over tests or people that are trying to sell you a test. That's the situation you want to be in here. Then we would know exactly where the virus is at all times. The reason I like this is because it doesn't count on a miracle happening. It counts on existing technology, but it's all about trying to scale up that technology and create a gold rush in the production of tests, not just in the US, but globally, and that would end the crisis. So I think all the money we're spending is like a lot of it's on the symptoms of the crisis and trying to scrape by through the second quarter, maybe the third quarter here. We don't really there's only so long that we can do that kind of thing. You want to find a way to bring an end to this using technology that's available today, and then hopefully you'll also get the vaccine and and the therapeutics and so on. So I just thought I'd pitch that idea and gin that up for discussion here. I'm happy to talk about all kinds of other issues as we go through this session today. But I think this is a time where economists have to step up and provide solutions. This is not a time to just say, gosh, the last time that bad things happened in the economy, it took a long time to recover. This is not the shock that we had in the past. So I don't think we should be extrapolating from any past data. We should be thinking about the current situation and what sorts of economic policies will bring this crisis to a close and get rid of the downside risk. We've got heavy downside risk on the US economy and global economy in this situation. So we have to come up with solutions that will end the crisis and put us back on firm footing. We don't want to be sitting around with 20% or 30% unemployment all around the world. I'm done. Thank you. I'll quit ranting.
The floor to Governor REHN.
Thank you, Mark. Ladies and gentlemen, good afternoon. Helsinki calling. Let me start by expressing my deepest gratitude to all those who are fighting the pandemic in the front lines in healthcare and elsewhere. We are facing a severe humanitarian crisis on a global scale, which indeed calls for a coordinated global response. The title of this session has two elements: reflections on policy responses on one hand, and the future post-pandemic monetary architecture on the other. I shall focus mostly on the first part, i.e. policy responses, which is the most burning matter in our time. Meanwhile, I admit I don't have the crystal ball beyond the current crisis to foresee its specific effects on the longer-term monetary architecture, but they are certainly not unconnected. For instance, the proposal for a new allocation of special drawing rights, SDRs, is closely related to the pursuit of a better functioning multilateralism. And by my reading and experience, there is no historical evidence that hegemony would create a more stable global monetary order than effective multilateralism. But I guess that should be a no-brainer for a body like this that is called Reinventing the Bretton Woods Committee. So I refrain from lecturing. Let me make 3 points in my introductory remarks. First, several analyses, including the scenario modeling we've done at the Bank of Finland here, suggest that forceful but relatively short-lived restrictions to limit the spread of the pandemic will result in significantly lower output losses and economic damage than a more gradual approach with milder but longer-lasting restrictions. Under any scenario, policymakers need to do their utmost to build a bridge over the troubled times to prevent a sharp rise in bankruptcies and job losses. Mostly, the policy response has been swift, learning the lessons of the global financial crisis. Central banks and also governments have launched an unprecedented monetary and fiscal stimulus to support the real economy and to prevent a credit crunch. My second point is that a globally symmetric crisis calls for a globally coordinated policy response. It is a symmetric crisis in a global scale, meaning that it affects both advanced economies and the emerging and developing countries. It is quite illustrative that the IMF is flooded with emergency financing requests from a vast number of countries. By now, 102 countries out of 189 members have requested IMF emergency financing of some sort. In order to be able to help its members and safeguard global stability, I find it imperative that the IMF has sufficient resources. Finland and its Nordic-Baltic constituency at the IMF has always been a resolute supporter of a strong and adequately resourced IMF at the center of the global financial safety net. Given the high uncertainty about the length and severity of the crisis, we must keep the door open for further measures. In our view, there is an evident case for a new general allocation of SDRs as part of the IMF's crisis fighting package. While the larger central banks like the Federal Reserve and the European Central Bank are providing massive liquidity support and preventing a credit crunch by their bold actions, I think we have to ask, why should we not amplify this liquidity producing impact in the global context through a new SDR allocation? Third, in Europe, the ECB and the Eurosystem have launched a very substantial monetary stimulus and other credit enhancing measures. It is necessary since the euro area economies are estimated to contract roughly by between 5 to 15% this year. Last month, the ECB started a new Pandemic Emergency Purchase Program, or PEP, buying both public and private sector bonds up to 750 billion euros. Together with our other programs, the ECB's net asset purchases will amount to more than 1 trillion euros or 1,000 billion euros this year. Furthermore, via its new targeted lending facility with significantly more favorable terms than previously, the ECB can provide liquidity to banks at a negative rate for up to 3 trillion euros. This is amplified by a very substantial collateral easing package just recently agreed. Moreover, as a supervisor, the ECB provides temporary capital relief to banks to support their lending capacity to the real economy. Altogether, these measures will provide ample liquidity and funding support to euro area households, businesses and banks. We will do everything within our mandate by the euro system to support the euro area citizens and businesses, especially SMEs, over these troubled times. Ladies and gentlemen, dear friends, on a final note, let me underline the crucial importance of global coordination. So far, we have seen a rather patchy policy response. For instance, Wednesday's G20 meeting was not exactly the greatest triumph of international cooperation. And the timing of the funding freeze of the World Health Organization could not have been more unfortunate. To my regret, this reminds me of Liaquat Ahamet's modern classic work called Lords of Finance, in which he describes the policymakers and their mistakes in the 1920s and 30s and the dramatic collapse of international policy coordination that contributed to the Great Depression and the subsequent Second World War. I recall former US Treasury Secretary Tim Geithner saying at the height of the financial crisis that he started reading Ahamet's book, but he had to put it down after a few chapters because he found it too scary. Let's not get back to the future, at least not to that kind of future. The country I know best, Finland, has had its fair share of tough times in its history. And as a small state, we have survived difficult situations by sticking together. Now we should stick together as a global community. I wish to trust that despite the physical distance prevailing now among us under these emergency conditions, we in the global community will nevertheless be able to pursue the kind of solidarity and international cooperation that is badly needed to overcome this crisis and to limit its damage in a fair manner. Let me wish you all stay safe and healthy, and thank you very much for your attention.
Thank you, Governor. Thank you, President Bullard. Now let's kick off the questions and answers. Per-Jan, do you want to coordinate that? And I see a couple of questions coming up. We can have a look quickly and maybe seize the one who are converging and ask President Bullard or Olli REHN to reply.
Sure, we've received a number of questions through the Q&A function in the webinar. The first question for President Bullard, there's been a lot of news about banks running out of money for PPP and the CARES Act. The money does not seem to be making it down to small businesses. How is the Fed and how is the government advising middle market clients on when they will see the stimulus funds?
Yeah, thanks for this question. The SBA is the Small Business Administration in the US. It administers loans to small businesses. So that was another example of trying to use an existing architecture, but try to force through a lot of funding through an existing architecture. So the amount of loans that are going through that channel are way, way higher than what would be normal. So you're really stretching the technology to its limit. But to their credit, the banks in the US have reacted appropriately. They get swamped with requests, and they have managed to originate actually the whole $350 billion or so worth of loans / grants to many small businesses. These are targeted to businesses in the US that are less than 500 employees, so that it is reaching small businesses. It's not just businesses, nonprofits are included, maybe some other types of entities. So I do think it's actually been quite successful. The take-up has been very successful. I think initially it wasn't clear. A lot of this depends on how you set up the terms. But it wasn't initially clear that you would actually get anybody to want to do this, but it turned out to work out very well. It's been very popular. So now Congress is going to have to put more money into it. The banks can't originate any more under this program because it's limited at $350 billion. So that's what has happened. Congress is negotiating between the Republicans and the Democrats. There seems to be consensus on the idea that they want to put more funds into this program, but the question is, do they want to do other things or not? So that's where it is in the Congress right now. But I'm pretty sure they'll take action pretty soon because their constituents are calling them all the time. I can tell you that small businesses really need this. They're not really designed to go 90 days or 100 days or 120 days without any revenue. Not that any business really is, but especially a small business, they're very tempted to just shut down operations and lay everybody off. So this is an alternative to that, where you would maybe greatly reduce operations, but keep people on the payroll. And this is a way to keep workers and firms connected so that when the economy is able to get back to full strength, you've got the same team in place and you're able to run your business more efficiently than if you had to go out and start all over again and find a whole new team to run your business and train everybody. So it has been successful. I think we will get more funding for it. We're in the middle of it because a lot of this is through the smaller banks in the US, the so-called community bank structure. They're the ones that have all these connections to all these smaller businesses. And so we're fielding all kinds of calls on this every day.
Thank you. We've received a number of questions on central bank digital currency. I'll just try to summarize these in a couple statements, and I'll let both of you respond. One is reactions to China's DCEP. There's been quite a bit of movement there over the past several weeks and months. How are the central banks, both in the US and throughout the Eurozone, taking that in, and thoughts and reactions to China's efforts in this space? The other is in response to the pandemic. There seems to be many more countries that may be planning to issue their own central bank digital currency in response to the pandemic. Do you see COVID-19 expediting or speeding up the adoption curve of central bank digital currency? Is it accelerating this trend? In general, thoughts on central bank digital currency and how your respective organizations are studying this issue and responding to it.
Am I supposed to open?
Sure.
Okay. I think that, the Fed has been looking at this from various angles for a while. We don't have any current plans to issue a digital currency, but I will say that the crisis has brought up, I think, a key issue because part of what the CARES Act does is try to give money directly to households. So part of what's going on, and we've been helping with this, is Congress said, okay, every family can get a so-called check. Checks don't really exist anymore, but okay, a check for $1,200. Now, it's one thing to legislate that, and it's another thing to actually turn around and try to implement that. It's a huge country, 327 million households. You have to somehow keep track of who you're sending the money to, making sure that you're getting households, especially those that are the most needy, get their check. That is actually a tremendous logistical problem and not the easiest thing to implement. So a lot of digital currency ideas balance for central banks, balance on the idea that you would have deposits or accounts at the central bank. And if you had that, then this would all be much easier because you would just credit all those accounts according to the way Congress wanted to do it, and you'd be done. So, and it would be much more efficient, much faster. What's actually happening is that it's going through the Internal Revenue Service, that's the tax collection. And so you've got the people that have filed taxes are gonna get their checks, relatively painlessly. Even that takes a long time. But then others that did not file taxes for whatever reason, possibly because they were low enough income that they didn't have to, it's going to be harder to get them their check and make sure that you've got the right money flowing to the right households according to what's in the CARES Act. So this shows up a kind of weakness in the current infrastructure that we have, which is a patchwork inherited from the past. But this could all be more efficient and more easily done. And in theory, people have talked a lot about accounts at central banks being a better way to implement monetary cum fiscal policy in the future. So I do think this is very much showing up in the crisis here.
Can I take the floor?
Yes, please.
Yes, thank you. So in fact, our friend Benoit will in the next session deal with the digital currency and central bank digital currency. To my understanding, he was responsible for the work at the ECB in the ECB executive board and is now leading the work in the Bank of International Settlements. I just say from our side that yes, the pandemic has amplified the discussion on digital money and central bank digital currency. However, in the end of the day, it depends on what do you mean by it, how do you define it, how would you implement it. And in this regard, I see that there are three kinds of phenomena in this field. First of all, and especially I'm talking as a Nordic, we need to support further real-time and mobile payments, and the European Central Bank and the Eurosystem is doing precisely that. That is a very clear priority. Today already over 80% of all payments in my country are done electronically, either mobile or other real-time payments. It may be actually higher already. Some estimates are at 90% today. So cash is somewhere in between 10 to 15% in terms of usage of money. The second issue is we are concerned about some phenomena like certain initial coin offerings where we have warned people about risks involved. And third, there are areas where we want to further develop, such as blockchain technology. And also we have an open mind concerning central bank digital currency. We are working together with other major central banks in the context of BIS and often bilaterally and internally, so that we are exploring and studying various options how to possibly create digital money. But for the moment, the focus is on more practical things, including on mobile payments and other real-time payments. Thank you.
Thank you. I wanted to come back to the significant developments that have come out of the government of China. At the Chamber of Digital Commerce, we've been studying what China's central bank has been building with DCEP. They've filed over 123 patent applications on their digital currency project. A massive work product underway that is in the process of being tested and implemented. How are the United States and the European Union central banks looking at the front runner here, or who seems to be the front runner, which is China?
Following the work closely, what is going on in China, and we are examining and studying the work that is going on there. In a way, I could quote my compatriot, the Nobel laureate Bengt Holmström from Yale, when he was discussing some time ago, he was discussing digital money and digital central bank digital currency. He said, and with due respect to my neighboring Sweden, he said that it would be actually better if some non-systemic country like Sweden or Uruguay would first test a central bank digital currency. Even more seriously, we are following this field very closely, and as said, we are working together with other central banks in order to see what are the best and more viable options in this regard.
Yeah, I would concur with that. We're following developments very closely. You know, for those that want to see my comments on digital currency, there are. I did talk at the Coinbase conference, which is now a couple of years ago, but the main things that I brought up there were that digital currency faces the same issues that traditional monetary policy faces, in the sense that the central bank would be leaned on to provide a credible commitment to limited supply in the future. Which is the key aspect of monetary theory as it's been developed over the last century. So just because you go digital doesn't absolve you of having to have credibility around the digital currency so that people are sure what its value is going to be in the future and are willing to denominate their wealth in that currency. So that's why I think private sector companies like Facebook or anyone else really, or a country would still face the ups and downs about their currency trading against other currencies which are already in existence. We have plenty of currency competition already around the world, and for new coins to come on in the virtual space just adds to the cacophony of currencies that exist all around the world. The digital aspect is not that important because dollars and all other currencies are traded very rapidly electronically all around the world. So the key to monetary theory aspects of this are, what is the future commitment to the future monetary policy? And I don't see individual companies being able to make those kinds of commitments. And even individual countries have a hard time making those kinds of commitments. I talked about Venezuela in that particular talk. So I think we have to think more deeply about digital currencies and how are you going to handle the core monetary policy problem that would exist no matter whether you do the currency digitally or you let a large government be the monopoly issuer the way it is today. You're still going to have exchange rates between competing currencies. those exchange rates are known to be extremely volatile. And the most successful currencies are almost always attached to the most successful countries. That's the way it's been historically, because those are the only ones that can provide credible commitment to the monetary policy. So I think the technology people around currencies have fantastic ideas about the technology aspects, but the core monetary theory aspects are still there and have to be solved in the same ways that they've been solved historically.
Let me ask you last questions, because there are a lot of questions related to helicopter money. You see distinctions, and I think this question is for both of you, Governor REHN and President Bullard. You see distinctions between quantitative easing and monetary financing. Will the Fed or the European Central Bank follow the step of the Bank of England that has become the first central bank to directly fund state spending? In other words, we will see some central bank engaging in monetary financing or fiscal deficit spending, or so-called helicopter money. What are the risks and benefits with this policy? President Bullard.
No, I don't see direct monetary finance coming out of this. These are all very standard moves that we made out of the playbook that was developed in 2007 to 2009. I guess just a month ago, March 15th, we met on a Sunday and lowered the policy rate to 0. I don't really think that the current environment is really about rates anymore. And then subsequent to that, we've employed the so-called 13.3 provisions in the Federal Reserve Act. That's the lending capabilities in unusual and exigent circumstances. Excuse me. So that provision is extremely powerful, and what has enabled us to keep the liquidity situation at a good place, at least for now, in the initial wave following this pandemic. And we can do much more on that dimension. The original 13.3 provisions that were in place from the 1930s said that the Fed could lend to anyone under unusual and exigent circumstances. The revised version under Dodd-Frank after the financial crisis says that you could still do it, but under more strictures than you would have had before, and you have to get the approval of the Treasury Secretary. But this is a situation where everyone agrees that it's a national emergency and a global emergency, so it's no problem to get those kinds of approvals. So you've got a very powerful tool here that we're using to our full extent, and we can go much further on that dimension. But I wouldn't call it monetary financing. It's really lending, not spending, as Chair Powell said recently, which I thought was a very good and concise line on this issue.
Governor REHN.
Thank you. My approach is very similar to Jim's in a sense that I don't see QE as monetary financing. In Europe, in the Euro system or the European Central Bank and the 19 Euro area central banks, the QE has been conducted mostly under the asset purchase program, which has been now recently supplemented last month by the pandemic emergency purchase program. For the moment, we have in our balance sheet, we have around 2,800 billion euros under these programs. And as I said in my introductory remarks, this will, in the course of this year, this will in net terms increase by around 1 trillion euros, which is a very significant liquidity injection to the Euro area economy. But it is merited because of our mandate, because of price stability, and in order to ensure the monetary policy mechanism. Inflation has been, especially if you look at core inflation, it has been around 1% in Europe over the past 5 to 6 years, even 7 years. while our target, at least before our strategy review, is below but close to 2%. So in 2014, we first engaged into quite significant unconventional monetary policy through zero rates and then negative interest rates, policy rates. This was followed in 2015 when the euro area was facing a deflationary danger by quantitative easing. This succeeded in terms of containing and combating the deflationary danger, but we still have rather low inflation and low inflation expectations, which is obviously further amplified by the COVID-19 crisis, which means that we will maintain our very accommodative monetary policy stance for quite some time still. And of course, because of the crisis and the current very difficult economic circumstances where our businesses, SMEs, households, citizens are today, we are constantly alert and ready to use all our instruments to facilitate supportive financing conditions in Europe.
Very good. Let's now maybe go to the second round and give Usman now the capacity to chair the second aspect of the roundtable. And after we might come back to all the speakers at the end. Usman, please, this is your turn.
Yes, fantastic. So let's move to the second part of the webinar. I'm delighted to have Benoit, head of the Innovation Hub of the Bank for International Settlements, and Professor EICHENGREEN of the University of California at Berkeley. So Governor REHN and President Bullard, you will stay on, so maybe an opportunity to actually participate in the Q&A following the next session. So let's start with Mr. Correa, please.
Thank you, Usman, and can you hear me well?
Yes.
Yes.
So thank you very much for inviting me to this webinar, and let me share very much what Olli said earlier, which is that the front line of this crisis is very much not in finance. It's about the medical staff fighting the virus, and all of us, central bankers, international financial institutions, we're very much the combat support or even the combat service support in this crisis. The front line is elsewhere, and we owe a lot to the people doing it. So you asked me to share a few thoughts about the world after the crisis, which is really an impossible task. I mean, we don't know how the crisis will unfold. We don't know when the crisis will end. The crisis is sending shockwaves across the global economy, which are just starting to be felt. They are very much felt in advanced economies, but they are just starting to be felt in the emerging and developing world. And they will come back. They will spill back to us. And so we know very little about how this crisis will unfold. That said, I believe that two broad themes will shape the conversation on the day after COVID-19. And these two themes are resilience and technology. So let me elaborate on what it means for international finance, taking them in turn, and starting with resilience. So I think a good place to start is that the global financial system has withstood the COVID-19 shock better than the great financial crisis in 2008. And it's fair to say that the success owes much to central bank bold action. But with insight, it also owes a lot to action taken by regulators in the decade after the last crisis, or in particular in the decade after the G20 Pittsburgh summit. Banks have been spurred by regulators. They've built capital buffers, liquidity buffers. They've improved their risk management practices. To some extent, they've internalized the social cost of risk-taking. And they were much better prepared to cope with a major shock in 2020 than they were in 2008. they can use buffers which very simply were not there at the time. So that's a good side of it. Now, despite the progress made by macroprudential policy, my take is that we've been much less good at making the global financial system more resilient as a system, as an interconnected system. We knew it before COVID-19, and it's being confirmed by what we're seeing around us. Market-based finance is a well-identified gap in macroprudential policies. We know we lack instruments to curb the procyclicality in non-bank finance. And what does it mean today? Why does it matter today? Well, in recent years, asset managers and funds have filled the gap that was left by the retrenchment of global banks. Shadow banking or market-based finance has increased tremendously everywhere, including in Europe. And today, in the face of outflows, these guys may be forced to sell assets and to amplify price adjustment. So that creates a fragility. And there is worse. I mean, if you come back to the first weeks of the COVID-19 crisis, we've seen fragility in the price discovery mechanism in large parts of our capital markets. Market liquidity has deteriorated faster and more broadly than in the great financial crisis, where money markets, by and large, were the most affected. Major funding markets have all been strained in advanced economies, and the strains are now moving fast to emerging market economies. And they are exacerbated by the uneven access to short-term dollar funding across the emerging world. So as a result, not only had central banks to address shortage in aggregate demand, which is what they do usually, but they had to perform laser surgery on a number of market segments to make them functional again, crossing into uncharted territory and having to invent new instruments. And the jury is still out as to whether the combined action of central banks and governments will be enough to avoid the liquidity crisis morphing into a solvency crisis, which would raise a host of new issues. So the lessons for the central banks and for the regulators can already be guessed. I mean, first, we need to make the system more resilient, and efforts to since Pittsburgh to make the system more resilient should not be dialed back. If anything, they should be increased to learn the lessons of what we've seen in the recent weeks. Of course, there is a lot of flexibility in the financial rule book, which is being used, rightly so. But the rules themselves should be protected. I mean, the rules are not infinitely elastic, and they should be safeguarded for the world after the crisis. And public support should come with conditions, such as restrictions on dividends and bonuses. And we should renew the impulse to improve the resilience of market-based finance, which honestly had waned before the crisis. And lastly, we should complete the global financial safety net as a matter of urgency, and we should focus on the smallest and the most vulnerable economies. Olli earlier in the discussion mentioned the proposal of the new allocation of SDRs. Of course, the extension of the global foreign currency swap network and repo network now is a very important step to address dollar funding needs, but it doesn't benefit all jurisdictions. And an allocation of SDRs, which would provide liquidity to all IMF members, large and small, would get into all the cracks of the global financial system and deserves to be supported. Let me say now a word about technology. What we see around us is that the crisis is exposing the value of technologies which enables the economy to operate at arm's length and to overcome social distancing, at least partially. We see dramatic changes in work patterns, in consumption patterns, such as a dramatic shift to online shopping, and that will have a lasting impact on economic relationships throughout our economies. One industry that immediately comes to mind is payments. Payments have been at the forefront of technological change recently. And if we see an even more rapid shift towards digital payments, this can improve cost, transparency, and convenience for billions of consumers. But we need international cooperation around it. We need international cooperation to support technological capacity in developing economies. We need cooperation to ensure interoperability between national systems. We need cooperation to enhance cross-border payments, in particular remittances, and to support financial inclusion. And the international community is taking these challenges very seriously. So in the last week, you had a flurry of reports coming from the FSB and the CPMI dealing with these issues. The FSB and CPMI published an action plan on cross-border payments, which was asked by the G20 presidency. The FSB also released its consultative report on stablecoins, on the regulatory implications of stablecoins. And the CPMI and the World Bank also released a report on the payment aspects of financial inclusion with a focus on fintech and how technology can help. So all of that is very useful. Which brings me to CBDC, which was a theme in the first session of that conference. The crisis also brings the current discussion on central bank digital currency in a sharper focus. Whether the COVID-19 will accelerate the demise of cash is an open question, but it raises the stake of the CBDC discussion. Presumably it reduces the bandwidth that we central bankers have to allocate to that kind of longer term and structural issues, because all of us, and particularly all of you, I mean, Olli, Jim, you've got to fight the financial crisis, but it also raises expectations, right? It highlights the value of having access to different means of payments and the need for any means of payments to be resilient against a broad range of threats. If you remember, in February, the BIS had a survey on CBDC, which showed that an increasing number of jurisdictions was working on CBDC, in particular in emerging and developing economies. We would expect the COVID crisis to accelerate this trend. And it will accelerate the digital transition even beyond payments. But let me conclude by coming back to today's urgency and making the link with the payment discussion. Technology can also help mitigate the economic and social impact of the crisis now. There is a debate on how technology can help track the virus, enforce quarantines, administer remote consultations. There is a debate on which safeguards are needed to protect privacy. I'm not going there because that's not my turf. But what I would like to point out as a conclusion is that technology can also help mitigate the economic cost of the crisis. It can help mitigate the economic cost of the lockdowns and avoid irreversible damage to society. And the reason why is that the most vulnerable in society are less likely to be reached by traditional support measures. And that's particularly the case in economies where direct tax infrastructures are less developed, whereas the informal economy is pervasive, that is all the developing and emerging world. And digital payments can enable governments to provide emergency support to households, to small businesses affected by the virus. They can help pump the money down the last mile. And we see already jurisdictions which have established retail payment and digital identity rails, able to leverage them to enhance their crisis response. The World Bank has written on it, giving the example of Chile. The ID-linked basic account in Chile, Cuenta Root, can allow already 2 million vulnerable Chileans to benefit from COVID-related support already this month in April 2020, because the infrastructure is there. And international coordination can also help keep remittances flowing, as those normally sending remittances are disproportionately affected by the crisis. And for those jurisdictions which haven't established digital infrastructures, it's not too late to do so. We can help them design the right strategies to advance financial inclusion and to innovate in payments. And certainly the international financial institutions, the IMF and World Bank and regional banks will be ready to commit technical assistance and support this transition. So the conclusion is that learning the lesson from the crisis is not enough. It's still time to act. Or as Jim said earlier in the discussion, it is time to step up and provide solutions. And I stop here.
Thank you very much, Benoit. Professor EICHENGREEN, please.
Thank you. Good morning, ladies and gentlemen. I've positioned my camera so you won't be distracted by the sun coming up behind me. And if I keep my voice down, it's because people are sleeping next door. I want to echo what Governor REHN said about our gratitude to the first responders. We're grateful also to the second responders, the central banks, I think, who've been fast off the mark and have helped us navigate this crisis more successfully than otherwise. I'm going to start by responding to some of the things that have been said. These two sessions have kind of bled into one another. Apologies for the metaphor, which is a good thing. Being the fourth speaker, on the other hand, much of what I had intended to say has been said. So let me react to some remarks and then repeat some of what has been said. I think what Jim Bullard said about the dangers of extrapolating from the past is very important. This is a different kind of crisis. Given what I do, I'm asked multiple times a day about how this crisis compares with the Great Depression of the 1930s, and I respond by emphasizing that this is a different kind of crisis, although some of the consequences could, like high unemployment, could conceivably be the same. Those kind of historical comparisons are valuable mainly for highlighting what is different about current circumstances, and I think we want to keep that in mind. My view of what comes next is a bit darker, I think, than what we've heard so far. I think this recovery will be slow, and I think this recovery will be bumpy. It will be bumpy because more likely than not, the virus will be back. It will be bumpy because more likely than not, some countries, including my own, will begin to open up in ways and at times that will require them to close down locally or regionally. Again, so I think there are multiple reasons for worrying that V and U and checkmark are not the right shapes for thinking about the recovery that we will see going forward. I think that recovery is likely to be slow as well because of the variety of hysteresis effects that people have been thinking about and worrying about, which range from bankruptcies to damage to human capital. And I think private spending will remain subdued for an extended period going forward. Lots of households have been reminded that they don't have adequate buffers against unforeseen shocks. They are going to engage in more precautionary savings. As they did in the second half of the 1930s, there is one valid analogy or parallel, I think, and firms are going to be cautious about ambitious fixed investment projects until they can be confident that the virus will not be back. Given that this is the Reinventing Bretton Woods Committee, I would also echo what people have said about the importance of international cooperation, and I would applaud the international cooperation that central banks have engaged in so far. Governments, less so. So a new allocation of special drawing rights to pick a round number of $1 trillion would be quite appropriate under current circumstances, but governments were not able to agree on the same earlier this week. Olli mentioned Lords of Finance. A self-serving comment would mention also EICHENGREEN and EUSIN, the 1933 World Economic Conference, as an instance of failed international cooperation. It can often be more difficult to get governments and politicians to agree to cooperate than central banks, and I worry about that aspect under current circumstances. I worry about cooperation at the European Union level, given the unsettled debate over to label it with one word, Corona bonds, although it's a much broader debate. And I worry more than Jim Bullard about cooperation between the Congress and the executive branch, and within the Congress, about aid to hospitals, aid to state and municipal governments, and aid to small business, whether we can come to agreement that all three are needed rather than some subset of the above. I was going to make some comments on private label digital currencies, although I don't have a lot to add to what has been said. For those of you who have enough bandwidth to look beyond the COVID-19 crisis, you will have seen that Calibra released a new white paper yesterday about Libra, Facebook's digital currency, where they've revised its architecture. So now it will be unspecified number of different stable coins that are each tied to an individual national currency. And then there will be an SDR-like basket of Libras of Libras. There will be a capital buffer this time. That's progress. The technologists have discovered the concept of the capital buffer, but we're not told very much about it, like how it will be financed, whether it will be countercyclical. And there's still no recognition that capital alone is not enough. You need that lender of last resort, and there's nothing like that on the horizon. So I think once again, some of the critiques have registered, but the idea is still a non-starter. Having said that, one of the benefits of the Libra initiative is that it pointed to the phenomenon of the unbanked, and the current crisis has underscored that that problem, the problem of financial exclusion, even here in the United States, where, as we've heard, the government is set up to provide people with emergency support checks by direct depositing them to people's bank accounts. So I think we're reminded of the value of developing fintech solutions to this problem, whether in the form of digital currencies, private label digital currencies, unlikely telecom, smartphone enabled solutions, more likely central bank digital currencies, likely in some places. I think the crisis has highlighted the limitations of fintech in substituting for existing financial institutions and arrangements. So in the United States, small business loans backstopped by the Fed and the Treasury are being extended by commercial banks, mainly to their existing customers. They're being vetted one by loan officers. And that's what has created a troublesome backlog. And the same is true of the loans that have been extended directly by the government's Small Business Administration. So I think this is indicative of the continuing importance of relationship banking and the difficulty of shifting to fintech solutions in this domain. The one fintech application I've seen suggested for breaking these log jams is adding a chatbot to the Small Business Administration's website, not a very revolutionary fintech innovation. But yesterday, interestingly, we had an editorial, the lead editorial in the New York Times, bemoaning the delay of getting $1,200 checks out to Americans via the banks, which were closed over the weekend, which took advantage of the float by sometimes delaying those checks an additional 24 hours. The New York Times editorial board apparently doesn't know what a central bank digital currency is, but they are advocating that the Fed open a retail account for each and every individual in the United States. So you can see how the current crisis will drive the conversation in that direction. The crisis has also pointed out the continuing dominance in international finance of the US dollar. And I think the Fed has inadvertently cemented that role of the dollar by being active in providing swap lines and repos to treasury repos to central banks. It needs to, I think further about the criteria, who qualifies for those swap lines, and entertain ideas that are out there about using the International Monetary Fund as an intermediary for those kind of facilities. I am not aware that the European Central Bank or the People's Bank of China have extended additional swap lines to central banks around the world, or that they have increased the value of the swap lines that were established previously, or that they've established the kind of national sovereign bond repo facilities that the Fed has. And I think it would be timely to move in that direction. Finally, the crisis will eventually, inevitably, the day after, lead to more conversations about moving to a less dollar-centric international monetary and financial system. Observers will worry that in some future crisis, the Federal Reserve system will be manned and womaned by less foresighted central bankers. In 2009, we heard PBOC Governor Zhou in the midst of the last crisis give an influential speech about what the future international monetary architecture will look like, and I think we will get there again. I think the central bankers on this panel, once they have a spare moment, need to start thinking about that issue as well. So thank you very much.
Thank you very much, Professor Eichengreen. Look, I think it's a fantastic opportunity that all four panelists are still here. Would President Bullard or Governor REHN, would you like to react to the comments, to the remarks made by Mr. COEURE and Professor Eichengreen?
I could.
Okay. All right.
Yes,
That's okay.
Can I?
Yeah, Governor. Yeah, Governor REHN.
Thank you. If I start, first of all, many thanks for the presentations, and as regards the issue that was raised by Professor Barry Eichengreen concerning swap lines by the European Central Bank and the Euro system, we are first of all very grateful and appreciative of the very quick and forceful action by the US Federal Reserve, which quickly engaged in quite aggressive balance sheet expansion and set up swap lines with several other central banks, including the European Central Bank, to support US dollar liquidity. We have a permanent arrangement, but that was extended. The interest rate was reconsidered and the maturities were prolonged, which has worked and has greatly helped in order to ensure dollar liquidity in the global financial and banking system. The European Central Bank has done the same to safeguard euro liquidity, because as you well know, there is a certain marching order. The critical lifeline in the world economy today is dollar liquidity. If you have that, that's fine. The next one is euro liquidity. And we have swap lines, for instance, with the Nordic central banks that are not members of the euro. And more recently, we have decided, just very recently, we have decided swap lines with, for instance, Bulgaria and Croatia. So I see that I refer to what we said about international policy coordination. In this regard, policy coordination works among the central banking community, and both the Fed and the ECB are doing their part in this regard. Thank you.
Thank you. President Bullard? Thank you.
Yeah, I just had a few comments and a few reactions, and thanks to our panelists for their comments here. I think on the question of what will the recovery look like, it's become popular to be very pessimistic among economists. I don't think we should do that. This is a different kind of a shock, and there's no reason why it's well known exactly what's going on here. The economy normally produces at a high rate. Health authorities have access to produce at a low rate for a period of time. And then we're going to get in better position to handle the health risk. And then we're going to be able to produce at the high rate again. So there's no reason why this can't be executed. This can be executed. I think we should focus on how can we get that to happen, and how can we get the best outcome. If we extrapolate from the past, and Lords of Finance came up here, so, and I think Professor EICHENGREEN also said, well, I'm not expecting it to be handled very well because I don't have much trust in government institutions. Okay, well, maybe that is what will happen, and maybe that is the reading of history, but our job here is to get it to happen. We know what the problem is, and it's a well-defined kind of project that you have to execute on. And we need a lot of cooperation, like anything in any emergency. You got a lot of things going on. It's very chaotic, but it's not hard to understand exactly what we're trying to do and where we're trying to get to here. We're trying to provide relief to people while we're in the pandemic adjustment period. We're trying to get to the point where we can control the risk around the virus. Vaccines and therapies, therapeutics, nice. But in the absence of that, let's test like crazy. That's exactly what we should do. Bring the crisis to an end, put people back to work. That can all be executed, especially on the scale of dollars and euros and others that we're talking about here. We're spending tremendous amounts of money to try to handle the symptoms of the crisis and not necessarily solve the crisis. As for fiscal action not being coordinated, I really disagree. I mean, the US Senate unanimously supported the CARES Act, and I think the previous acts that came out. You can't get the US Senate to agree that the sky is blue. I mean, there's not been that kind of thing happening, except for sort of major events where everyone gets on the same page and says, okay, we see we've got a problem. We see we have to do a lot, and they've stepped up and done that. So I think there's really been unprecedented action in a very short period of time. We're only about 4 or 5 weeks into this. It's just astounding what's been done so far. So I think this can be executed. I just wanted to comment on the swap lines for just a minute. Dollar funding, as Governor REHN said, is a critical issue around the world. We do have standing swap arrangements with central banks, but we have also innovated on that dimension and gotten out of the business, I think, of trying to decide who gets the swap line and who doesn't, by allowing foreign central banks to come directly to the New York Fed with their treasuries and trade them for dollars. That is relieving a lot of funding stress that would otherwise occur in the dollar funding market. If you have a currency that's used all around the world, like the dollar or the euro, you are going to have these issues. So I think it's incumbent upon the backers of those currencies to be able to handle those kinds of risks, and we're certainly doing that. On the fintech solutions, I do think that there are companies out there that are lending based on artificial intelligence. Square is the one that I know of. I see that as very valuable going forward. I see that as an inevitable trend. I don't think it's quite at the point yet where we could do as much as we'd like to do, but and one of the issues for them is that they have to handle fraud very carefully because there are always those that are trying to hack and beat the algorithm. So, but it is being done, and I see this crisis as pushing that forward even more aggressively. So I'll stop there.
Thank you very much, President Bullard. We have a number of questions. Many are actually directed at emerging markets and the concern, how the crisis will affect those that are, structurally more vulnerable. Because we have very much a technological audience, I'd like to direct one question here to Mr. COEURE, and then there's another one for Professor EICHENGREEN. The idea of CBDC, making it possibly easier for also smaller currencies to be used in international transactions. The dominance of the dollar was mentioned, the importance of dollar funding was mentioned. Do you see in CBDC a possibility to overcome existing barriers for greater adoption of smaller currencies in international transactions?
I'm not sure. I'm not sure that the way it works, because CBDC will be, I mean, there will be less frictions, to put it that way. There will be less frictions to using CBDC. CBDC can be used across a very large network internationally, so that may very well reinforce the dominance of existing dominant currencies. And so if one day you have a dollar CBDC, that might make the dollar even more dominant than it is today, right? Crowding out smaller currencies. So I'm not sure. I'm not sure it's such an opportunity for smaller currencies. It's certainly good domestically to cut on the cost of payments, to make it safer. Look at the discussion today on the virus and cash, right? That the virus is in itself a push towards using digital payments, contactless, etc. So there can be huge domestic advantages, which should be acknowledged also for financial inclusion. But internationally, I'm not so sure. CBDC might very well reinforce the kind of network externalities that come with being a dominant currency. I'm sure Barry knows more about that.
Yes, very much a question related, actually. Will the dollar be even more dominant after the crisis? Is one of the questions being asked here. What is your view?
I think the importance of dollar liquidity has been highlighted by the crisis, and central banks and others are going to be replenishing the coffers. They've been reminded about the importance of dollar liquidity by events. So in the short run, absolutely. But as I said in my earlier remarks, there are questions that we need to ask about the international monetary architecture in the longer run. Two other quick comments would be, will central bank digital currency make a difference for the international monetary system? I think the central bank to watch is the PBOC. They have in mind that central bank digital currency can be used exactly to foster the internationalization of the renminbi. Is that a viable strategy or not? I have my doubts also. So that's the case to watch. And finally, to President Bullard, you're quite right. You're in the business of executing and keep doing it. I'm in the business of kvetching and raising questions about the policy design, and I intend to keep doing that as well.
Very good. Look, we are on the hour. I think this may only leave, we have many questions, but this may only leave a few concluding remarks now. Back to you, Mark. Thank you very much to Benoit and Barry for your remarks.
Well, Usman, just thank you for everyone. I think it was a good experiment. I think for us, it's been the first time we use that technology to organize a virtual meeting. I think we all miss the face-to-face, but I think this is the second best solution. And I hope that we can continue this series, and we'll keep you updated about the next phase. I think there are a lot of questions were driven about emerging markets. I think this is going to be important, as we have been seeing a huge capital outflow that was, I think, bigger than the one we have during the super tantrum. And I think your policy response, international cooperation will be very critical. Thank you, everyone. Perian, maybe I give you the last word.
I just want to say thank you again, Mark and the Reinventing Bretton Woods Committee, as well as the Center for coming together to host this discussion today. And big thanks to all of our guest speakers, President Bullard, Governor REHN, very much appreciate you taking the time to come and speak with us. You guys have a lot on your plates these days, and it's really important that we have the opportunity to have an open dialogue, and we appreciate your time, as well as Professor EICHENGREEN and Benoit over with the Bank of International Settlements. Thank you for taking your time and for sharing your thoughts with us. Want to wish safety and health to all of our participants who are on the webinar with us. Wish everyone a great weekend and hope you are all well, and we will share with you the details of our next session soon.
Thank you.
Thanks so much.
Thank you very much.
Thank you very much. Bye.
Bye.